Hi, thanks for joining me today. My name is Eric Brown. I'm with Canaccord Genuity Wealth Management and I'm part of Graham Wealth Partners. If you like our content today, please like, subscribe, comment. Love to hear from you. If you want more details, you can go to our website at www.grahamwealth.com. Today I will be talking about insurance. Everyone's favorite topic. Yahoo! Let's get into it. There's a lot of insurance jargon, there's a lot of articles, there's a lot of talk about it. You've probably heard of whole life and term and critical illness and riders and face values and all kinds of things, but what I want to do today is simplify it for you. There are really only two types of insurance that we can talk about. That one is what happens if you die, and two is what happens if you get injured. So let's talk about that first one. What happens if you die? When you die and you have life insurance, the beneficiaries get paid out. So the beneficiary is essentially the person that you assign to the insurance policy. That can be your spouse, your kids, a charity, it can be your business, it can be, there's any number of things that you can have as your beneficiary. And within life insurance, there are two main categories as well. So you've probably heard of term insurance, maybe you've heard of permanent insurance. Term insurance is exactly as it sounds. It has a term. That means it's going to end at some point. Most typical, most common terms are 10 years, 20 years, sometimes 30 years. And what that means is you buy it and then it will last for 10 years. And typically after that 10 years, you have the option to buy more or continue the term, and your payment, your premium will go up at that point. And there's typically a certain age at which you can't extend the term anymore, and then it just lapses, goes away. Pay your money into it and it goes away. The second type of insurance is permanent insurance. Again, pretty self-evident on what permanent insurance is. It lasts permanently. That means that it will continue being insurance as long as you pay for it until the day that you die, or whoever's insured. Could be you and your spouse, could be you and a business partner, and there's different features in it, and it's typically more expensive because the insurance company knows that they're going to have to pay you money, so they want to be compensated for that. Within that, there's universal life, there's whole life, there's term to 100, T to 100, and there's all kinds of different things involved with both of those. So if we look at the uses for both of those insurance, term is usually bought because you're covering a need. And that need is often you're a young family and you're just starting in your career. Maybe you just bought a house and you have a mortgage. Maybe you've got young kids and at some point you want them to go to school. You buy them so that you would have the money to cover off all your expenses as well as future expenses, so that your life would not be impacted to a negative degree, at least financially. And so you would buy, if your kids are just born and you think that they're going to go to school in 20 years and you've got a mortgage and you're going to pay it off in 20 years, well then maybe it's a good idea to get a 20-year term so that during that time, if something should happen to you, then you pass away, the insurance policy pays off, the mortgage gets paid off, the kids' education gets paid off, and there's money left aside for paying for the life, for your lifestyle. So that's term insurance. Used for a term, used for a specific purpose, and it goes away. You don't get anything from it once you stop paying for it, or it pays out, or it expires. For permanent insurance, the use is different. The use is for longer term. So typically you're looking at your estate. You're looking at taxes and charges at death. You're looking at tax savings. You're looking at corporate tax planning, where you're trying to get money out of your corporation and protect. You can protect your business. You can do it with your business partner, and it's something that will last with you for the rest of your life, but it does cost more money. And you can get all kinds of features in it. We won't get into the different features of that, but it is customizable. And depending on the type of whole, or depending on the type of permanent insurance, it's more or less customizable. So that's the permanent versus term. Now, for the type of insurance that protects your health, you have two commonly used insurance, and then there's one that's available but is less common. So the first one is critical illness. Essentially what that means is that if you get a critical illness, which is a condition that the insurance company lays out when you sign the insurance contract, and it can be 20, 25 different conditions, such as cancer, such as stroke, such as Alzheimer's, that if you get one of those conditions, you get paid out. And that is designed to really give you peace of mind, that when you're going through a circumstance, or going through a situation, that you have some money, that you can use it to go on a vacation. You can use it to pay for extra health expenses. You can use it to go to another jurisdiction, to another country, to get additional help that you wouldn't be able to get in your home country. And so you don't have to use it for any specific purpose. You just get that money tax-free, and it really is peace of mind. And it's actually something that I've used and I personally own. And my wife, after our first child, had a situation where she thought that there was a tumor, a cancerous tumor. Thankfully, it turned out to be nothing. But it was something where we knew that we had money if we needed it, and it really was a relief, so that we didn't have to focus on the monetary side of things, but we could instead focus on making sure that my wife's comfortable and the brand new baby was doing well, and taking care of our family. The second type of insurance that can be used for health purposes is disability insurance. And really, when you think of it, we all have a much higher chance of being injured, being disabled, than we do of dying. And that's something that we don't often think about, that we need to be able to protect our ability to make money, so that we can fund our retirement, so that we can fund our day-to-day expenses, and that we can take care of our family. It's very important to review your disability insurance to make sure that if you do have it through your work, that it covers enough for your day-to-day expenses. And if you don't have enough through work, or you don't have any at all through your work, that you make sure that you get something in place, so that if you were injured, that you do get compensation. And again, on both critical illness and disability, there's lots of different variations of it. You can get them that last longer, you can get them that have a higher premium at the beginning and lower later. You can get them with return to premium. You can get all these different bells and whistles that we don't need to get into the details today. But if you look at it, you have two options with insurance. One is protecting your life, one is protecting your health. And within those, there are two main options. Within life, you have your term insurance, which lasts for a certain term and then goes away, and then permanent insurance, which lasts forever. And then in the health, you also have disability insurance and critical illness. And then one other thing in the health insurance is the long-term care, and that's used to help support you when you're going into a long-term care facility and you're moving out of your home. You can get insurance to cover that. So you've got to look at the pros and cons of, will you have enough money for that? What are the costs of the insurance? And does it make sense for the long term? If you have any other questions, I'd love to get into the details and have a discussion with you. Please go to our website at www.grahamwealth.com.